When company Modern Tech released an initial coin offering for their cryptocurrency Pincoin, they promised a 48% return per month from the investor's initial investment. As a further enticement, Modern Tech offered 8% commission for investors to bring others into it. What an offer! Sounds too good to be true? Well, the Pincoin ICO did well, making roughly $660 million, none of which was returned to investors after the Modern Tech founders mysteriously disappeared. Initial coin offerings are a method used to raise money on the internet for a blockchain network. To invest in an ICO, you send cryptocurrency or money. In return, you are issued digital tokens or crypto coins. It's important to note that ICOs are not the same as initial public offerings, or IPOs. ICOs do not have any legal rights or protection because the cryptocurrency market is not regulated. Without regulation, this has made cryptocurrencies an attractive avenue for criminal activity. Several altcoins such as Monero and Zcash have taken the opportunity to build blockchain platforms that don't show transactions on an open ledger. So both the user and their transactions are hidden. Cryptocurrencies like these have attracted black market dealings. At a consumer level, individuals have been targeted by cryptocurrency scams. In Melbourne, victims were contacted by fraudulent debt collectors who convinced them that their immigration status was in jeopardy if they did not pay a debt. The fraudsters demanded that the debt was paid by depositing Australian cash into a Bitcoin account ATM. Of course, none of it was true, and the victims lost $50,000. The challenge of law enforcers is their ability to keep pace with innovation. To date, neither the IASB or IFRS have provided guidance on how to handle cryptocurrency. The challenge for cryptocurrency is how do you define what it is in accounting terms? In the United States, regulatory authorities are challenging the notion that cryptocurrency users must remain unidentified. In 2017, the Internal Revenue Service subpoenaed customer records from an exchange platform in a bid to identify tax cheats at the point of which they convert cryptocurrency holdings to local currency. The IRS argued that because cryptocurrencies are not legal tender or backed by any government, they are not a property asset and not a currency. Therefore, all transactions are subject to tax. In Australia, the ATO has provided guidance on the tax implications of using cryptocurrencies. The ATO also considers cryptocurrency as property. Therefore, if the cryptocurrency is disposed of, exchanged or invested, it is subject to capital gains taxation. The ATO requires all ownership of cryptocurrency to be disclosed. To recap, cryptocurrency is providing an exciting new approach to the global finance industry and has the potential to disrupt the industry. But we already see challenges for the authorities. The principles of complete transparency with Bitcoin are not being replicated by other altcoin platforms, enticing illegal and criminal activity. Accounting bodies are struggling to keep up with the technological innovation, but will have to create standards and practices on accounting for cryptocurrencies. Regulators are also behind the 8 ball relating to the tax implications on cryptocurrency transactions. However, tax regulators are already defining Bitcoin as an asset and not a currency, meaning that all transactions are subject to taxes.